Hi, everyone. My name is Molly Burton. I'm a certified financial planner and financial advisor at Greenspring Advisors. And I also have Zach Hubbard on the line with me today. And we're here to give you our Moments of Clarity Quarter 2 2021 webinar about the 10 simple steps to a better investment experience. So let's dive right in. Many fund managers believe that they can identify mispriced securities and convert that knowledge into higher returns. But fair market pricing works against these kinds of efforts, and as indicated by the large proportion of mutual funds that have underperformed their benchmarks. The market itself is an effective information processing machine. You can see here, 2018, $462.8 billion, the daily average trading in equity. And the market's pricing power really works against mutual fund managers who try to outperform through stock picking or market timing. And as evidence shows, only 23% of U.S. equity mutual funds and 8% of fixed income funds have survived and outperformed their benchmarks over the past 20 years. In this chart, the light gray bars represent the number of U.S. equity and fixed income in operation during the past 20 years. The funds themselves compose the beginning universe of that period. Now, the dark gray areas show the percentage of equity and fixed income funds that survived that 20-year period. The blue and green represent the smaller percentage of equity and the smaller percentage of fixed income funds that survived and outperformed their respective benchmarks during that period, so over those 20 years. So our research really shows that over both short and long-term horizons, the deck is stacked against mutual funds that attempt to outguess the market. So we want to resist chasing past performance. Some investors may resort to using track records as a guide to selecting funds, reasoning that a manager's past success is likely to continue in the future. Does this assumption pay off? Not really. The research offers strong evidence to the contrary. This exhibit here shows that among equity funds ranked in the top quartile or 25th percent based on the previous 5-year returns, a minority also ranked in the top quartile of returns in the following 5-year period. This lack of persistence really casts further doubt on the ability of managers to consistently gain an informational advantage on the market. Some fund managers might be better than others, but track records alone may not provide enough insight to identify management skill. Stock and bond returns contain a lot of noise, and impressive track records may result from good luck. The assumption that strong past performance will continue often proves faulty, leaving many investors disappointed. Tip number 4, let markets work for you. Most people look to the financial markets as their main investment avenue, and the good news is that the capital markets have rewarded long-term investors. The markets represent capitalism at work in the economy, and historically, free markets have provided long-term return that has offset inflation. This is documented in the growth of the wealth graph, which shows the monthly performance of various indices and inflation since 1926. You can see here the data illustrates the beneficial role of stocks in creating real wealth over time. T-bills have barely covered inflation, while longer-term bonds have provided higher returns over inflation. And U.S. stock returns have far exceeded inflation and significantly outperformed bonds. But another key point is that not all stocks or all bonds are the same. For example, let's consider the performance of U.S. small cap stocks versus U.S. large cap stocks over this time period. So U.S. small cap stocks are in the dark blue at the top, and the large cap are in the light blue right below it. A dollar invested in small cap stocks in 1926 would be worth considerably more today than a dollar invested in large cap stocks. But keep in mind that there's risk and uncertainty in the market. Historical results may not be repeated in the future. Nevertheless, the market is constantly pricing securities to reflect a positive expected return going forward. Otherwise, people would not invest their capital. Number 5, if there's anything there that in the whole world of mutual funds that you can take to the bank, it's that expense ratios help you make a better decision. Expense ratios are the costs associated with the investments in which you are invested in. We can control the costs and thus control how much of our dollars are being invested and earning a rate of return year after year after year versus our dollars that are going towards fees. In every single time period and data point tested, low cost funds beat high cost funds. I'm going to repeat that. Every single time period and data point tested, low cost funds beat high cost funds. Expense ratios or fees are a strong predictor of performance. And in every asset class over every time period, the cheapest quintile produced higher total returns than the most expensive quintile. I'm going to pass it over to Zach to talk about our next 5 tips that you can take to have a better investment experience. Zach?
Thanks, Molly. So tip number 6 is to practice smart diversification. Too many people concentrate their investments in their home stock market. So you might want to consider a portfolio that's diversified when they choose large cap stocks and US mutual funds. But in reality, if you only hold a US securities, you're really not diversified. You want to build a globally diversified portfolio, because limiting your investment universe to just a handful of US stocks is really a concentrated strategy, which carries additional risk and some return implications as well. So this slide just offers us a look at the difference between a global market index portfolio and the home market index portfolio. As you can see, if you're just concentrated in the home market, even though you own 505 stocks, you're still really in that one asset class if you're concentrated in the S&P 500. Whereas if you are broadly diversified in that global market index portfolio, you own 8,722 stocks across 47 countries. So the comparison there is very powerful, right? Because you can see that if you globally diversify, you have access to a broader universe of stocks to invest in, and you're also diversified across different countries. So you're balancing out some risks across the investment universe. Tip number 7 is to avoid that market timing. You never know which market segments will outperform from year to year. So when you're holding that globally diversified portfolio, you're well positioned to seek the returns, wherever they happen. So you look at that chart on the right, and it looks like just a quilt of a bunch of different colors, right? But what that shows us is which asset classes perform the best year over year, right? So you can see as those colors are moving up and down the chart, it's really difficult to pick which asset class is going to outperform on a consistent basis, because none of them really outperform on a consistent basis. So when you build that globally diversified portfolio, when you try to avoid that market timing, trying to pick the winners in each year, as you can see by that chart, is very difficult. It's very hard to pick which index is going to outperform or which asset class is going to outperform in any given year. So by building that globally diversified portfolio, you're able to capture those returns without having to adjust or having to really return seek, right? Or go out there and try to pick the winners. You're able to just capture that market performance and capture those top performers by building that globally diversified portfolio. Tip number 8 is probably one of the most important ones, and that is managing your emotions. So building a great portfolio is awesome. Building that globally diversified portfolio is great. Avoiding market timing, all that other stuff is really great. But if you let your emotions get the best of you while you're investing, none of it really matters. So a lot of people tend to go through this cycle that you see on the chart, that optimism, things are looking good, elation, things are looking really, really great. Then you start to drop down a little bit to nervousness, like, okay, things are getting a little rocky here. People might be experiencing that now. Then you get down to fear. Things are looking really bad, right? Things are scary. The market's scary. I'm worried that it's going to go down. And then once that happens, once you hit that bottom, you bounce back up to optimism. But if you can stay flat across that curve, right? If you can manage those emotions, separate your emotions from your investments, make sure that you're staying true to your plan, the plan that you devised, that globally diversified portfolio, you got to stick with it. If you can do that, if you can separate your emotions from your investing, you are going to be successful in most cases, right? If you can just avoid making those emotional, irrational decisions with your investments and really just invest according to your plan, that is the key. That is a key thing for investing success. And part of that, to help you out with that, is tip number 9 here, right? Look beyond the headlines. Headlines, the daily market headlines that you see, they are designed to make you look, right? It's kind of the old made you look that we used to do as kids, right? They throw one thing out there, they throw a shocking headline onto something that probably really isn't all that important. So you don't want to just react to the headline. I think too many of us are doing that now. Too many of us look at those headlines, they see, oh, sell stocks now, or retire rich, or the recession is coming, or the bubble's about to pop, right? And then we react to that. We don't really read past the headlines. But if you see something like that that's calling your attention to it, read deeper into that article, right? Because in reality, what they're probably saying is really not all that alarming. It's not all that shocking. It's just all about getting you to click, getting you to look. That's how those news companies, they make money, right? They make money by getting you to click on those articles. So if you can avoid that temptation of reacting to the headline and reading deeper, right? Or just simply ignoring it altogether. Maybe you don't watch CNBC, or maybe you don't look at Yahoo Finance or Google Finance, where those headlines exist on a daily basis. Try to avoid reacting to those headlines, because that really helps you with that tip number 8, right? Managing your emotions over the course of your investments. That's really the key to making sure that you can stay focused on their long term. Again, those headlines, they're designed to make you look. So if you do decide to look, make sure you actually read the article before you really react to that article or to that headline. And the last tip number 10, focus on what you can control. So when it comes down to it, we don't control the markets, we don't control the headlines, we can somewhat control our emotions, right? But what we can do is we can create an investment plan that fits your needs and your risk tolerance. You can structure your portfolio in that globally diversified manner. You can manage your expenses. You can manage your taxes in the portfolio. You can manage by managing your turnover. And you can stay disciplined. You can manage yourself, right? And if you're struggling to do that, if you're struggling to build that plan together, or by yourself, you want somebody to help you with that. Our team, the Clarity at Work team, myself, Molly, and Cindy, we can help you build that investment plan that aligns with your goals. We can help you build that diversified global portfolio, and we can really help you manage your emotions through those market swings. So to get in contact with us, you can go to greenspringadvice.com. That is our Clarity at Work website. If you want to, you can create an account on there, but you don't have to schedule a one-on-one meeting. There's a button right in the middle of the screen as soon as you log in that says schedule a one-on-one. Click that button. It'll take you to a calendar service that'll pull all of our calendars, cross-reference our availability. You can choose the date and time that works best for you. Schedule that meeting with us, and let's talk. Let's talk about your investments. Let's talk about your investment plan. Let's help you figure out your risk tolerance, or anything else that you have questions on about investments. If you're worried about the current market, reach out to us. We want to help. We want to talk to you. So please don't hesitate to go to that greenspringadvice.com, schedule that one-on-one meeting. We're always happy to help. So thank you for joining us today. Thank you for listening to this presentation. I hope that you found it valuable. From Molly and I both, as I stated, we are here. We are ready to help. So please don't hesitate to reach out to us with any questions that you have. Thank you for listening, and I hope you have a great rest of your day.